This is the loanable funds with investment demand. So we have our supply of loanable funds, demand, and where those cross, we get the real interest rate. So we have the quantity of loanable funds, and equilibrium will give us the price of borrowing from the bank at the real interest rate. Now, there's a certain level of investment that happens at that interest rate, so I reflect it or bounce it off of the investment demand curve, and that investment demand is going to be reflective of the real interest rate, because the real interest rate is what the supply of loanable and demand of loanable funds will show us and what banks really want. Okay. So if there's a demand for loanable funds, there's either going to be a supply of bonds go up, or people are going to show up to the bank and want to borrow. So if that shifts to the right, what is that going to do to interest rates? Well, we have a certain amount of supply, and now there's more demand. So if there's more of it, more people want it than there is of it, that's going to make prices go up. So the demand for loanable funds would shift to the right, and where it crosses a certain amount of money available, if a bunch of people show up to the bank and all ask for loans, that's going to make the price of that money sitting there go up. So I reflect this over and down, and that gives me less investment is going to happen at a higher interest rate. So the demand for loanable funds goes up, that's going to make the real interest rate go up, and that's going to make investment go down.